mortgages, and we are going to talk about Excel a little bit, but you don't necessarily need Excel while you're watching this video. So first off, we've got two formulas that we're going to talk about, the PMT and the PV function. So the periodic rate, what does this mean? So you see it here. Well, usually in mortgages, you make a mortgage payment, right, every month. So when you talk about interest rates, usually you talk about interest rates as APRs, which are annual percentage rates, and periodic rate means for the period that you're dealing with. So periodic rate generally means a monthly rate. So in our formulas, if we have an APR, we will divide that by 12, because an annual rate divided by 12 now becomes a monthly rate. Oh my gosh, I just answered question number 2. So the periodic rate, to calculate it, if you want it to be monthly, you divide by 12. Now, if you wanted that to be, weekly, you could divide it by 52. You can do whatever you want. The period, you always just take your annual percentage rate and you divide it by how many times a year you want to make a payment. All right. Number 3, how do you calculate the number of payments? So now we're dealing with the middle piece, the number of payments. Well, again, let's go back to just monthly. If you make a house payment every month, that's 12 in 1 year. And then you multiply by the number of years. So if you have a 30-year mortgage loan, then you're going to take 12 times 30, and that's how many payments you're going to make, because you're going to make one every month for 30 years. If you're only on a 15-year note, then you would take 12 times 15, right? So it kind of depends on your loan for sure. Okay, PMT stands for payment, and it's used when you want to find the payment. So this is saying you know that you want to buy a $300,000 house. Okay, this is your interest rate. This is how many years your loan is. What's your payment going to be? So it's when you know how much you're borrowing, right? I'm borrowing $70,000. How much is my payment? So the PMT, payment function, to find the payment. The PV is known as the present value, and it's used to find the value of the house. So in this case, you're like, you know what, I can really afford a $570 house payment. You know the payment, so if I know how much I can afford per month, how much of a house can I buy? So the PMT tells you, when you're trying to find the payment, the present value is when you're trying to find the value of the house. So there's kind of the difference. What are you trying to find? That's the formula that you use. All right, so the question. Beth and Joe are expecting a baby and decided their house is too small for their expanding family. They find a new home listed at $118,000. Their bank has pre-approved them for a 30-year mortgage, 3.75%, and a 15% down payment. What is their monthly payment going to be? Now, we're trying to find the payment, so we are going to use the PMT function, but we have to do a little bit of math first, because they're not going to borrow. They're not borrowing $118,000. They've got to put 15% down. So first things first, if I take $118,000 and I multiply by 0.15, my down payment is going to be $17,700. Well, when you put a down payment down on the house, it comes off of the amount that you need to borrow, right? So their $118,000 house, and we're going to take off the $17,700. They only need to borrow, $100,300. Right? That's the amount to borrow. BRR. Struggling there. Okay, so as I said earlier, we are going to use the PMT function. Now, we've got to do our periodic rate. Well, we know that our rate is 0.0375, but that's an APR divided by 12. Because, again, you're making 12 payments in a year. Now, how many payments are they going to make? Well, 12 in a year times 30, because there's 30 years in the mortgage, and then comma, how much are they borrowing? Negative $100,300. Boom. Notice there is no comma in that number, and it's negative because they're borrowing that money, right? It's going away. So if you type that into Excel, the negative $100,300 at the end there, you will come up with a monthly payment of $464.50. And you can try that, all right? Plug that into Excel and see if that works for you. All right, number 7. Mabel is attempting to purchase a new home, but she wants to know which of the loan terms her bank is offering would be a better option. She's been offered a 15-year loan at 3.25% or 30 years at 4.5%. She needs to borrow $69,800. Okay, so she's going to have two different problems, right? So let's do the 15-year loan first. We're trying to find her payment, right? All right, so 15-year loan, 0.0325 divided by 12. 12 times just 15 years, and she's going to borrow 69.8. Okay, then we'll do her 30 years, PMT. That has a different rate, 12 times 30, but she's borrowing the same amount of money. Okay, now when you type those into Excel, the top one, you get a monthly payment of $490.46, and for the 30-year loan, you get a $353.67. Okay, so you can see clearly that the 30-year loan, even though it's a little bit higher interest rate, you have a lot smaller payment. So if you're worried about, the house payment, 30 years is the better option. But if you can afford a $490, which one is in the long term? Okay, so these two payments are both monthly. Well, if I multiply by 12 and multiply by 15, because remember, yellow is the 15-year loan, Mabel's going to end up paying back $88,282.80. Now remember, she only borrowed $69,800, but you pay back interest, right? And in the 30-year mortgage, so this is the monthly payment, times 12 months in a year, times 30 years in the mortgage, she's going to end up paying back $127,321.20. It's not quite double, but it's pretty close. So you can see that if Mabel can afford a $490 house payment, she's going to save herself almost $40,000 over the course of her mortgage. So it definitely, in the long run, makes more sense, right? It's not as great up front, but it's going to help her in the long run. Number 8, Noelle makes $50,000 annually, wants to know what size of a mortgage she can afford as she plans to move. So she expects to taxes $650 a year. Her homeowner's insurance is $850 a year. She's got a $300 car payment, makes a $100 credit card payment. So what do we need to know first before we can use Excel? Well, we need to know what kind of monthly payment she can afford. Right, because she's trying to figure out how much house she can have. Well, we need to know her monthly payment. We also need to know an interest rate. We also need to know the term of the loan. Right? Is it 30 years? Is it 15 years? Is it 10 years? Right? So these are all things that we can do. Now it says what amount of payment can she afford? Well, let's do that. So we talked about 36% of her monthly gross. Well, we know that her annual growth is $50,000, and if I divide that by 12, I get monthly. And then we're going to subtract her homeowners, so the property taxes and the insurance. But those are both annually, and again, we want monthly, so we divide them by 12. And then we're going to subtract the car payment and the credit card. So when I do that, I end up with $1,500 minus $125 minus $400. So Noelle can afford a $975 house payment, according to the bank. Now, we don't know the interest rate or the term of the loan, right? That's not given. So we are going to assume that she can do the $975 monthly payment. And just for fun, we are going to say 30 years at 6% interest. So I think right now, 6% is high for a house. So we're going to estimate high. Because if you can afford, at this, then you'll be able to get more at a lower interest rate. So we're trying to find present value. The present value of the house at a 6% interest rate divided by 12. 12 months in a year times 30 years in the mortgage, and she's going to pay $975 a month. If you type that into Excel, Noelle can look for $162,621.82 house. So, if you can get a lower interest rate, you can get a bigger house. But if Noelle looks at $160,000 houses, she's probably going to be okay with how interest rates are right now.